Now, another one that is actually getting interesting here is PayPal. PayPal is starting to sell off with the normal financial institutes here, and I don't think they have as many headwinds as your brick and mortar. All right, ladies and gentlemen, today we're going to go into companies that are actually hitting our price targets. It's like Christmas. All of a sudden, we're starting to see companies actually hit valuations that we've been talking about for a very long time on the channel, but there's many dilemmas taking place here. Now, as you can see, Verizon Wireless is now trading right around $30 a share. Now, we got right around $29 to $32 a share, which is putting it right in the wheelhouse of where we were expecting to possibly buy Verizon. And so I'm going to go over this company really quick here, my concerns, the opportunities, all that good stuff here. So let's talk about some stocks that are actually on sale and that are hitting valuations that we've broken down on the channel. So this one's going to be numero uno that we're going to talk about here. This one's probably pretty popular with a lot of dividend investors and people that are relying on dividend income. It's pushing over a 8.5% dividend yield. And while that seems good on the outside, the inside is where the problem is for Verizon, with total debt sitting at $176 billion. We're going to kind of talk on dividends here a little bit because I want to talk about risk premium versus equity dividends, right? So when we talk about risk premium, how much additional risk do we need to take on for us to buy an equity versus a treasury? So what we're starting to see here is the risk premium that's taking place in the treasury market. Right now, you're getting almost 5.5% sitting in a 1-year treasury and over 5.5% sitting in a money market account. And so when we look at an 8% dividend, a 9% dividend, and dividends that are under 5% is starting to make you question, should you be buying equities right now in a very high risk environment, or should you be taking the easy layup and getting a 5% nearly risk free? Along with that, it is a balance sheet question, or companies that need to create debt in order to create growth. And so a company like Verizon falls in that category with the 5G build out. The competitive market landscape is costing Verizon a tremendous amount of money and is costing all telecommunication companies, including AT&T and T-Mobile. But I do believe that there's going to be a technology reignition coming in the next few years with AI. We're probably going to see new electronics hit the market, and there's definitely a technology boom in the background here that I think is going to get recaptured by these legacy type companies that are kind of been underperformers. And when we look at what they've done over the last 5 years, take a look at this chart, guys. It has done nothing but go down in a straight line. So while it's been offering 6-7% dividend yields, and yes, now it's pushing 8.5% because of the price, on this channel, we were not recommending these types of stocks in the environment that we were seeing over the last 3 or 4 years. We ran our evaluations and we came up with right around $29 and $30 for something like Verizon. I believe AT&T was sitting right around $12 to $13. And when we look at something like Realty Income sitting right around $50, a 5-year high on the company was pushing $80. Once again, similar story, not quite as drastic as something like Verizon, because I do believe that the balance sheet is obviously stronger in a company like Realty Income, because I do believe the balance sheet story is much stronger in Realty Income. The interest rate market's going to keep this one from growing, and the questionable aspect of commercial real estate is obviously trading in sympathy. And there's probably going to be a little bit more downside risk with this one if we see rates still going higher. Heavily leveraged companies and REITs have been where we want to stay away from, but now they're getting pretty interesting where price points may be making some sense to start taking on some risk here. Now, another one that is actually getting interesting here is PayPal. PayPal is starting to sell off with the normal financial institutes here, and I don't think they have as many headwinds as your brick and mortar regional banks and even some of your big banks here. And so this one is definitely getting interesting. We have to look at this one as a mature company now. Growth rates are going to be fairly flat, and so now this is a story about getting in at the right price. And can they make some acquisitions or develop inside to reignite growth? And this one is now hitting our price target between $50 and $55 is where we had this one earmarked. 52-week low in the stock was sitting right around $55, currently trading at $57. Once again, the chart is pretty ugly on this one. And so When you're seeing your valuations come underneath, you just have to be patient with a lot of these stocks. A lot of the times there's so much perfection priced into these stocks that you have to wait for a perfect pitch. And so PayPal, Verizon, these are some companies now that are starting to get in our wheelhouse where we can make sense of possibly buying some of these up. And so when we break it down to a sector by sector performance over the last 6 months, we can see that the S&P 500 has been up just around 5%. But take a look at the underperformers here. Utilities down 18%. Now with utilities, this is normally a safe haven, much like your dividend stocks. And so there's multiple reasons why we're seeing utilities underperform. Number one is going to be that if you can get the same yield in a treasury, why would you take the equity risk premium, which we talked about earlier? And number two is going to be that there is debt on a lot of these utilities. They are high debt, highly leveraged type companies here. And so multiple headwinds here for utilities. But if you think rates are peaking out and you think we could have a slowdown, this will probably be a great area to outperform. Along the same lines is going to be consumer staples, which has been a massive underperformer here, down almost 12%. And what have we been hearing about the consumer? The consumer is now slowing down and trading down. Money's getting a little tight. And so consumer staples should be another area where we could start looking where multiples are really low, depressed, kind of a sector that's really getting overlooked, and they actually navigated the high inflation market very well. They were able to pass down inflation and still grow in a high inflationary market. And now with deflation, are they going to be able to grow? And I think you have to pay attention to the companies that are doing some good acquisitions, which I brought up on the channel as Campbell's Soup being one of them. And that's another one that's actually hitting our price target. But if we take a look over the last 3 months, take a look at real estate here, down 11%. Now, this is all a story about yield spiking here and the ability to refinance at higher rates. And now real estate is in a big time shift here. Commercial real estate specifically. Residential real estate is probably going to perform fairly well, but commercial real estate is definitely in question as we're seeing less and less people work at the office. And this is impacting a lot of your major REITs. That's a big reason why we've seen realty income fall off here. Pays a 6% dividend, but you can get 5.5% risk-free. Big questions about refinancing in 2024. So we have Walmart in the black, and we're gonna put Target in the red here. And over the last year, Walmart's up nearly 19% and Target's down 32.5%. Massive outperformance here by Walmart, massive underperformance to the overall market when we look at a company like Target. This goes to show that this is absolutely a stock picker's market here. If you were just to buy a basket of consumer staples, you're probably underperforming. But if you're overweight an individual stock like Walmart, you are massively outperforming. In our next video, we're going to go over some AI companies, 2 small cap companies and 2 large cap companies that I believe have a good footprint in AI and that are going to perform well in a very uncertain market. So make sure you hit the bell, like, and subscribe if you want me to go over those stocks. And as always, appreciate your time. Thank you so much for spending it with me, and we will see you in the next one. Peace.